It is only a matter of time before the central banks start coming for your Bitcoin. By the end of this video, we will see why a sitting central bank governor publicly argued for Bitcoin reserves with a working paper and what his study found. We will also look at what happens to the BTC price as the institutions absorb more than the miners produce. We will also look at how much Bitcoin each central bank would buy at 1% and what those numbers would translate to in terms of the price action. Finally, we will look at what the top institutions in finance today are pricing Bitcoin price by the end of this year. So let's dive in. First, let's look at the setup. And this was actually the mic drop moment. Bitcoin Conference 2026 in Las Vegas. The governor of Ketch National Bank walked on stage and said, "Central banks and Bitcoin. Most people do not put these two things together, but I do." And this is not ideology because he brought a working paper that was actually a research paper which was peer reviewed, and it showed that just allocating 1% of their portfolio as a central bank to Bitcoin increased their expected returns while keeping the risk flat. Aside from that, we can see that the crypto exchanges just hit a 7-year low in terms of their BTC reserves. Aside from that, we obviously know that the miners produce only 450, can't keep up with the daily purchases. So if you look here, this is the daily mined 450 BTC. This is what we can see as the ETF inflows for top ETFs like BlackRock and Morgan Stanley, which is way above the 450 average at 1,200. Here, it producing 450 BTC a day. This is what structural supply shock looks like before it's priced in. Chapter 2, we have the exchange reserves that are visibly going down. As we can see, this is the chart of all the reserves across all the exchanges, and they are at an all-time low. This usually indicates that people are transferring their BTC from exchanges onto cold wallets, which translate to long-term conviction. This is the interesting juicy part of the expected return was around 3.8%. This usually meant bonds, equities, and some allocation to gold. This was the expected return with just 1% of BTC added to the portfolio, which increased to 5.1%. The overall risk, if you look at the risk with the traditional, it's at 4.2, and with the BTC it's 4.3, so it's relatively the same. However, you can see it's a relatively significant jump in terms of the expected return. So this is the experiment that the central bank is running for 2 years. Let's jump into chapter 4, the domino scenario. 1% allocation across major central banks. So this was the first Ketch National Bank, of course, but if different central banks follow suit, then we can see that these are the different allocations that would translate to 1% of their portfolio. And here we have the People's Bank of China, which would be a massive 400,000 BTC allocation with just 1%, followed by Bank of Japan and so forth. This is, of course, a hypothetical order to provide liquidity for the trades on the exchanges. Moving on, we have Chapter 5, price targets. So we can see that the current price stands at approximately 76,000. We have I takeaway from this whole research piece. What actually happened, the catch I think may have a deciding impact on the price going forward, which is the Clarity Act markup, which is May 2026. Any central bank formal allocation announcement or the Fed chair, Kevin Walsh, which is the new Fed chair, taking over May 15th, rate cuts, liquidity expansion, anything could turn out to be a Bitcoin historical tailwind, and there could be aggressive repricing of BTC going forward. The domino hasn't fallen yet. When it does, this dashboard is why you were ready. If you like it, give it a like, subscribe to the channel. Thank you.